My guest today is Katelynn Minott. Katelynn is a managing partner of Bright Tax, a CPA consultancy that provides individual tax preparation services and small business reporting for U.S. expat clients in over 150 countries around the world. She's been featured in Forbes, Fast Company, Bloomberg, and CNBC, among other publications, and I invited Katelynn to the podcast today to share tips and insights about federal tax changes to be aware of as you file your 2020 tax returns over the next month. Katelynn, thanks so much for joining us today to share filing tips for this year.
Yes, thank you for having me. It's a pleasure to be here.
I'd love to start just by learning a little bit more about your background. What is your background in tax and what kind of practice do you focus on or specialize in as a CPA?
Yes, so I am a CPA in the state of Massachusetts. I have been for the last 12 years. I began my career at PwC in Denver, Colorado, then relocated to Massachusetts, back to the Boston office. But after some time in Big Four accounting, I decided to venture outside of the traditional realm of accounting and actually moved abroad to South America, to Chile. And at that point, I departed from the traditional accounting career. I left my Big Four job and joined Bright Tax, which is at the time was a startup accounting firm. Bright Tax specializes in tax services for Americans living abroad. Now, 10 years later, I'm a partner, and our firm, I'm proud to say, has won numerous awards. And we have clients all over the globe in more than 190 countries.
All right, wonderful. So the topic today I wanted to chat with you about is around tax filing changes to be aware of for covering the year 2020 that folks are filing now in time for sort of tax day in April. And there's, this year's probably unlike any year in recent memory. There's a pandemic, there's stimulus checks, there's a lot of people were out of work, and like a whole host of things that, and there were also, changes in the tax rules. So I'd love to dive into some specific topics, but first, before we even do that, I wonder if you might be able to call out, anything noteworthy at a broad level with regard to tax brackets or capital gains rates or standard itemized deductions, et cetera. We don't have to sort of jump into specific threshold numbers. I mean, I can direct folks to look those up on their own, but anything that folks broadly should be aware of in your view when it comes to kind of the broad sort of tax framework that most folks are familiar with when they file their taxes normally, along with filing deadline changes, et cetera.
Yeah. So you mentioned that the filing deadline changes last year because of COVID. We saw the IRS push back the filing deadline to July 15th. As of today, as of the moment we're recording this, there has not been a change in the filing deadline for this year. April 15th is still the individual filing deadline for American taxpayers. There are, however, calls by the AICPA, the American Institute of CPAs, to push it back to June 15th. Expats actually, coincidentally, do have a June 15th filing deadline. So for our client base, June 15th is already our traditional filing deadline. And everyone inside and outside of the US can extend their filing deadline automatically to October 15th. In terms of filing thresholds and tax rates, we didn't see any major changes there. Everything looks pretty consistent with 2020. The tax rates didn't change. The brackets always increase year to year to reflect inflation, but no other major changes in that sense.
Okay, excellent. All right, so with that context, I'd love to jump into some specific topics and then kind of get your open thoughts around how folks should think about each topic as they file, as well as any notable changes that we saw this year. So first, 2020 obviously was the pandemic year. So we had the CARES Act, stimulus checks went out. Some people got those, some retirees got those even. And I wonder if you might comment a bit about tax treatment for any benefits that folks may have gotten from the CARES Act.
Yeah. The CARES Act did bring a lot of changes, benefits. Many were COVID related. Of course, the stimulus checks that went out in 2 rounds, and now a third is on the horizon, were kind of the major attention getter for last year. the big question that I've been getting from many of our clients is, are the stimulus payments considered taxable income? The answer, at least from the US tax perspective, is no, it's not. So you're not going to be reporting those stimulus payments as income on your tax return. Another kind of positive item to mention is that those payments don't have to be paid back if you triggered or went over the threshold for eligibility for those payments based on your 2020 income. But if you didn't get the stimulus amount that you were expecting, that because of perhaps you had a baby born during the year, or your income did fall in the 2020 year, you can expect to get a refund on your 2020 tax return. If you've fallen within the thresholds. And the third round of stimulus payments has passed in the Senate, so it's likely to be sent out this month, some point during the month of March.
Okay, got it. So when it comes to, so that's helpful. And when it comes to healthcare related changes, because folks, I guess, depending on your circumstances, may or may not have used more healthcare than normal.
Yes.
Are there any healthcare related tax changes that folks should be aware of?
Yeah, there were definitely a number of provisions. The first is the adjustment of or the permanent, I suppose, adjustment of the threshold at which you can take itemized deductions for medical expenses. So the CARES Act made permanent the provision to make medical expenses that exceeded 7.5% of your AGI deductible, where previously it was 10%. So that made that provision more permanent. There were also some changes to the definition of qualified medical expenses, so kind of amplifying that definition, allowing more medical expenses to fall under that itemized deduction area. And well, in addition to healthcare related changes, there were also some retirement plan changes, which was a welcome change for many experiencing financial hardships during the pandemic. The Secure Act, which just went through relatively recently, repeals the maximum age for traditional IRA contributions. So you can continue to contribute to a traditional IRA throughout your lifetime now, where previously you weren't able to do that. Early withdrawals is another always hot topic. People who need those funds to take advantage of for many reasons, but one of the provisions is now that you can take from an IRA or a 401k plan a $5,000 early withdrawal amount penalty free upon birth or adoption of a dependent child. So that's welcome at those milestone moments in life where you need the extra funds. You can now take those early withdrawals without worrying about a penalty. And other types of early withdrawals that are now permitted penalty free include withdrawals to pay student loan debt. That's another key one that many people find themselves in a situation where they're paying student loan debt throughout their career and lifetime, and you can now take $10,000 penalty free to do that.
Got it. You mentioned, so a lot of good stuff there. You mentioned that there were some additions or changes to qualified medical expenses. Are there any examples that are important that folks should be aware of, or new additions to what's considered qualified?
Yeah, I think the most popular one and the one we heard about kind of making headlines was actually feminine products. So that's a big one that we saw.
Got it. Okay. Any other noteworthy things to call out with regard to healthcare or retirement plans that you would advise?
A couple of other ones that perhaps aren't as significant, but definitely worth mentioning for people who have to take required minimum distributions from a deferred retirement plan or a deferred tax savings plan. The required distributions now begin at age 72, where previously they were beginning at age 70 and a half. Another one that perhaps is a little bit more of a restriction than an ease would be for an inherited IRAs. So if you are the recipient of an inherited IRA, In the past, you were able to stretch the required minimum distributions over your life expectancy, but the new rule requires you to actually make that distribution within 10 years of receipt of that plan. So that's important to keep in mind as another change. Inherited IRAs, this would be effective for somebody whose date of death was after January 1st, 2020. So it wouldn't apply to any IRAs that you already have in hand prior to that date.
Are there shifts in strategy that you see arise, or that you anticipate will arise due to this change, this 10-year restriction?
Well, I suppose for those who have inherited IRAs, they're pretty well developed through the course of their investment life. So there's probably not a lot that can be done in terms of mitigating the tax effect when you ultimately do distribute from them, because much of the growth within the plans themselves has probably already happened. But I would say the ability to progressively distribute over that 10-year period, ensuring that you're smoothing the income as much as possible throughout the distribution period, that would be one strategy to at least mitigate the tax impact.
Got it. Okay. I wanted to tee up, so I polled some of my audience to ask. I mentioned that I'm doing an episode with a CPA for tax filing season, and so send in your questions. And one of the questions that was asked was whether what advice or tips you have for when it comes to strategies for reducing investment income taxes, sort of while we're on the topic of retirement plan.
Yeah. So the investment income tax, also known as the NIIT, that is a 3.8% tax on investment income. It is relevant to areas of the tax return such as interest, capital gains, dividends, anything that's a passive investment source. And this generally applies to the higher earners, because it only kicks in once you've hit a certain AGI. But some ways to at least reduce or try to be tax efficient in this way would include strategies such as loss harvesting. So at the end of the year, looking for where you anticipate a large gain amount for the tax year, kind of reviewing your portfolio to dispose of any losses that you don't expect to come back. I guess keeping in mind that this is not financial advice, this is just from a tax perspective only. Investing perhaps in stocks that are growth stocks versus those that would pay out dividends throughout their life, and really investing in growth over the term. Perhaps finding ways to invest in tax-free vehicles such as municipal bonds. That's another strategy to reduce your interest income and therefore that tax. For those who have more control over the timing of gain income, for example, if you're a real estate investor, perhaps when you're selling real estate, you could participate in an installment sale agreement. So rather than receiving all of the gain in one tax year, spreading that gain over the life of whatever that contract might be, and therefore bringing down your overall income, perhaps taking you outside of the margin that would make you subject to the net investment tax in the first place. Another strategy, I think, which isn't just related to the net investment income tax, but also for any taxpayer, would be just taking advantage of tax deferred accounts. So the 401k, the IRA, taking advantage of those to bring down your overall taxable income, which will in turn bring down your falling in within that threshold in the first place. So.
Yeah, you mentioned among the different types of investment income you might recognize. So, whether it's capital gains or qualified or unqualified dividends, coupon payments on a bond or debt. You mentioned the different types of sort of accounts that have different tax profiles. Is there a recommendation that you typically give, or at least for tax purposes, that you suggest to clients about how to hold these assets to reduce the tax liability that they may incur from these type of income or gains that are recognized?
Sure, sure. I think it depends on every taxpayer specific situation. Some clients can take advantage of lower income years to sell off investments, or some can are looking for kind of a more smoothed out income situation where they're getting those dividends, where those dividends would make sense for them because they don't want to avoid the larger event at the tail end of the investment life. So it's really kind of on a taxpayer or per client basis that we would make those sort of recommendations.
Yeah, it makes sense. One thing I'm curious about is whether you're seeing in your practice, like during the pandemic. So first of all, a lot of people are working from home, which means they don't necessarily have to be where they were living before. So a lot of people relocated, whether it's temporarily or permanently. And then a lot of people's like income streams may have just shifted. Maybe
Yes.
they had to take off time to care for loved ones. Maybe they lost a job, whatever the case may be. Maybe their business actually went gangbusters, like if they worked at Amazon, for example.
Yep.
Are you seeing shifts in the types of, I guess, strategies that you're helping clients with, or the types of tax situations that you're encountering during the filing season, that you're able to sort of generalize some broader observations or tips for how folks in these type of situations might optimize their tax filing this year? Does that make sense?
Yeah, it does make sense. And it's been a very interesting year, like you suggested, because some people saw their income balloon, some people saw their income disappear, some people lost a job midway through the year and got a job at the end of the year. Others had situations where they're moving from one state to another or from one country to another unexpectedly. So there all of a sudden arise all of these circumstances that are unanticipated, which of course didn't leave room to plan for in many ways, but end up driving complications from the tax filing perspective. When a client of ours, for example, has a low income year, we would look to strategies such as doing an IRA conversion. So rolling over from an IRA to a Roth IRA to take advantage of that tax-free or eventually tax-free vehicle in a low income year. So that's kind of one very basic strategy we would look at. But like you said, the variety of circumstances that came up last year have really made it a challenging year because we didn't have room to plan in many cases for some of these challenges.
Interesting. Are there moves that people can make after the fact, or is it much harder once like you're kind of thrust into the situation of, say, having to move or having to change your hours or your work shift, etc.?
Right, right. There's not a lot that can be done after the fact, unfortunately. With tax planning, a lot is preventing or planning to make everything look more tax efficient. So the IRS did provide some relief, but it tended to do more with international movement and relocation than within the states, the US itself.
Got it. Okay. We'll definitely want to jump in the international stuff in a moment. But just to, I guess, round out here, are when it comes to education-related tax changes, like
Mhm.
last year, for example, there was a student loan interest suspension for a period of months. I don't know if that's still going on, but I wonder if you might comment on any education-related tax changes that folks should be aware of,
Yeah.
ranging from loans or CARES Act changes, 529s, et cetera.
Yeah, absolutely. And my understanding, if I'm not mistaken, is that principal and interest payments on federally held student loans were automatically suspended through September 2021. So there's a lot of leniency there. And that was a result of the CARES Act, if I'm not mistaken. Another one that I really was enthusiastic about seeing in the CARES Act was that the CARES Act allows employers to pay about $5,000 towards student loans on behalf of their employees. And that payment is tax-free to the employee. So it's really kind of incentivizing employers to reward their employees in different ways than they normally would. Another one that actually isn't necessarily education based, but I also really enjoyed seeing was that historically charitable contributions and giving well, at least the deductions associated with those were somewhat associated with higher earners who were making itemized deductions. But the CARES Act also had a provision that allowed for up to $300 itemized deduction for cash contributions made in 2020, even if you're not itemizing deductions. So anybody who made a charitable contribution in cash during the year can use that deduction, even if they're not itemizing.
Oh, interesting. So most people are the vast majority are going to take the standard deduction now that those thresholds have increased post Tax Cuts and Jobs Act. So you're saying you can still take on top of your standard deduction another $300 cash contribution for charitable donations. Is that right?
Right. That's right. And I suppose in some ways that's meant to incentivize charitable giving.
Yeah, it makes sense. Okay, great. I did have another question from polling the audience around small business, for small business and sole proprietors. The question was around commonly missed business deductions for self-employed individuals or sole proprietors that I guess this isn't necessarily specific to 2020. It could be just generally, but what are some of the commonly missed deductions that you see that you would encourage folks to just be mindful of?
Yeah, the common ones, I just made a punch list in my head of the ones that we see most frequently. Home office expenses. So because it's not a bill that's going out the door associated with your company, it's easy to overlook. Maybe those newer self-employed individuals, those are not necessarily aware of that. That's home office expense, which can include your utilities, internet, phone, anything that's associated with your office at home. The self-employed retirement contributions, that's another one we see people miss. So when you're working as a self-employed individual, you have the opportunity to contribute to a SEP. And so that's definitely one to take advantage of as well. Business debt interest. So if you have debt associated with the expenses that you are incurring as part of your business, then that's another good one. Health insurance premiums as a self-employed individual are also deductible. So that's another one that's good to keep an eye on, as people also associate that with itemized deductions typically. And then business meals. So if you're going out for lunch with a client or some sort of business purposed meal, then 50% of that can be deducted on your Schedule C.
Got it. On the last one in particular, because I know that one can get kind of dicey, or it can just get tricky. And I was curious, it seems clear if you're in a professional service type of role and you're taking a client out as an example that you just gave. What if you're say, a real estate investor, and part of your role as a real estate investor is to go search for prospective real estate property investments, et cetera. Under what's the scenarios like that would you, or maybe you're just a knowledge worker of some kind, you're a freelancer or whatever, but the point is you don't have clients per se because you're kind of doing individualized work. Under what circumstances, if any, are you able to deduct a portion or all of meal expenses?
Sure. So the rule to follow is that if the expense is ordinary and necessary as part of your business operation. So depending on the nature of your business, is that expense absolutely ordinary and necessary as part of your ongoing operations? If I'm just sitting at home working at my computer and want to order out lunch, that's not going to be ordinary and necessary. That's a personal expense. But if I'm on the road because as an investor, I'm seeking, a property or working on a deal that could potentially, as long as my travel is business, 100% business oriented, then that could be considered a business expense.
Interesting. So if I'm prospecting for real estate properties all day, the commute, the transportation, plus the meals that I take out during that day should be considered business expense. Is that correct?
Sure. Yeah. And the IRS does provide per diem rates that they can use as a guideline as well for that sort of travel. Okay,
awesome. Okay, so shifting now to international tax issues and issues affecting expats, which is, I guess this is kind of like the sweet spot for you. I'd love to understand from your perspective, what are major changes that folks who are residing abroad, expats, should be aware of this tax filing season?
Yeah, yeah, absolutely. I mean, expats to begin with have a completely different approach to tax filing than the normal American taxpayer. There are different mechanisms that we use to eliminate and reduce their US tax bill based on their residency, the tax that they've paid abroad. I mean, to start with, they have different deadlines, as we discussed a bit at the beginning of the conversation. The filing deadline is June 15th. That can be extended to December 15th. So the filing season for the expat world of taxation is really ongoing and never ending, because it spans throughout the whole year. As far as changes this year, there's not a lot, I guess. Knock on wood, to speak to for the 2021 filing season, beyond the stimulus payments, which, believe it or not, were going out to Americans all over the globe, which is a surprise to many. But just keeping track of those, making sure people are getting those, and if not, reporting the required refund request on the 2020 tax return has kind of been the major topic for this season so far.
Got it. Okay. So all the other kind of major things that folks, abroad, tax issues that folks abroad will deal with, like the foreign earned income exclusion, those structurally anyway didn't change. Maybe the rates adjusted a little bit for inflation or whatever, but are essentially the same. Is that right?
For the most part, they are the same. I referred to a little bit the COVID relief that the IRS rolled out. That COVID relief related to the foreign earned income exclusion basically said it accommodated those taxpayers who had to move back to the U.S. because of COVID, because of the fact that many were actually kicked out of the country that they were residing in abroad and sent back to their home country because of the conditions. The IRS did allow and does allow for people to be in the States for a significant amount of time in the 2020 tax year and still take advantage of that foreign earned income exclusion provision, where otherwise the time that they've spent stateside would preclude them from taking that benefit. So we did see that positive note. The income that the people earned while in the States is still subject to US taxation, like it would for the normal taxpayer. But at least we saw a little bit of relief associated with that exclusion.
What was the change specifically in that regard?
So if you had to return back to the US after March 15th, because of the COVID situation, and you would have anticipated otherwise to qualify for the foreign earned income exclusion, they'll allow you to continue to take it for the full year, disregarding that travel. And that allows for many taxpayers abroad to take up to $100,000 of earnings tax-free. But that period of time that you spent in the States after March 15th is still, you can't exclude that income because it was earned on US soil. So you're only eligible to exclude the income earned before you return to the States.
I see. So at the maximum, it would be like January 1 to March 15. Is that right?
Exactly. And perhaps if you returned after, later in the year, if you returned abroad again, November or whenever that might be for each taxpayer, that income earned after that date also.
I see. And that's, I guess the exception here is because normally the foreign earned income exclusion requires you to be outside of the US for some threshold number, I forgot the number, but some threshold number of days. And you
Right.
wouldn't have been if you came back on March 15. Is that right?
Right. The physical presence test exactly is what you're referring to there. And it requires you to be abroad for 330 days. The bona fide residence test is the other test you can utilize. And that has a little bit more leniency in terms of travel dates in the US. But even still, if you're a bona fide resident of a foreign country and if you return to the US for 6 months, potentially you would be ending your bona fide residency abroad. But fortunately, there's an exemption for 2020.
Got it. Incidentally, on this issue, I know of a bunch of folks who, after the pandemic, lockdowns went into effect, they're working from home. Some folks actually just moved abroad. Maybe they originally were from abroad and they had a green card, but they moved back during the pandemic, or they just went abroad. I was curious, if their prior residence was in a high tax, like a high state income tax state, like California, or for example, New York has pretty high state income tax. Um, when they move abroad, are they still paying state income tax as a general matter? And if so, what would they have to do to? It's probably too late now because the year's over, but maybe for future reference, what would they have to do to lessen their state tax burden? Do they have to relinquish state, I guess, residency? And if so, how would they even do that?
Right, right. Yeah, that's another one that it's good to plan for, but it's hard to plan for when you're in a situation like that. We saw this phenomenon where a lot of people are returning back stateside because of COVID. But I think now that so many people have realized that they can work remotely from wherever they are, it's going to trigger this reverse phenomenon once travel restrictions ease up, where people are just going to be traveling the globe, and wherever their laptops finds them is where their workday will look. But from a state filing perspective, the short answer is it's really depends on the state. Some states have very cut and dry rules about if you spend X number of days here, you're considered a resident. And if you are absent for X amount of days, then you're no longer a resident. And those are the nice states to depart, because when you move abroad to Thailand, that state's not going to be sending you notices and asking for your tax once you've departed. California is kind of notorious for being what I always call a sticky state. California, if you live abroad and intend to, by the state of California's criteria, intend to return to the state ever in your lifetime, they're probably going to consider you a resident. So one of the strategies that we've seen people use is to actually relocate to another US state, establishing domicile elsewhere before they move abroad. So if we're talking income tax-free states like Florida, Texas, those are the ones that people are going to probably relocate to for a few months, set up a mailing address, voters registration, driver's license, all of those kind of areas of residency that will prevent California to come knocking on the door later on. That's one strategy to break state residency, but it's important to understand your specific state rules to be able to achieve that cut and not have to continue to pay income taxes.
Gotcha. Okay, that makes sense. I happen to be in California, and a bunch of my listeners are. I'm actually, if you happen to know, are there any alternate paths besides using this kind of detour strategy of going through a tax-free state, or is there any way to do it so that you could just relocate abroad in one move, relinquishing your California residency and convincing California, I guess the franchise tax board,
Right.
That you in fact intend not to return and redomicile in California later in the future? I assume that doesn't preclude you from visiting California as Disneyland or whatever on vacation,
Right.
but you just can't redomicile. How would you prove that in a single move if you didn't take this detour strategy?
I mean, we see people do it. People just depart, and they file a part year resident return, which says I'm no longer a resident as of this date, and sometimes it flies, sometimes it works fine. So it doesn't mean the state of California is going to come knocking in the door, but it's about risk tolerance. Certainly, as a CPA, it's our job to tell you what the rules are and make a judgment call based on your facts and circumstances. But it's important.
Or I guess, like, what are the markers that would, as a CPA, that would indicate to you that, okay, this person is more likely to be sort of free and clear from the stickiness of California, and this other person is less likely to be? What are some of the markers that you might see?
Yeah, so some of the kind of checklist items that we go through are, again, voters registration, driver's license, having a property in the state that's available for you to use, bank accounts, anything that's going to drive income that's sourced within the state that might catch the attention of the state. So a rental property is a really good example. If you have a California rental property that's generating income, you're going to be on the California state tax board's radar. So keeping yourself off the radar is a good plan. But every state, again, is different and uses different criteria. Again, going back to take a vacation in Disneyland is not going to subject you to tax, but there are definitely other factors that might.
Got it. Cool. I think that's all I have. Where can listeners find out more about you, your work, your services, et cetera? This is super helpful.
Yeah, absolutely. So head on over to brighttax.com. That's where you can find more about the services we offer. We have a team of specialized CPAs that are fanatical about providing outstanding client service, in addition to obviously the tax technical advice and expertise. But we offer, in addition to tax preparation services, we offer consulting and planning services for those who are considering a move abroad. So, anybody who has that itch and wants to kind of know what that looks like financially, that we're happy to talk through that and offer kind of the financial projection from a tax perspective in that regard. On our website, brighttax.com, you can register and connect directly with a Bright Tax CPA who will guide you through the process from start to finish.
All right, excellent. We'll definitely link to that in the show notes. And thanks so much again for taking the time to share these tips with us today, Katelynn.
Yeah, thank you. It's a pleasure to be here today.
Cheers. Bye.